What is up? Good morning, everyone. Hope everyone is doing well. Welcome. Um, it is what is it's Wednesday, October 4th here. We've got some interesting stuff going on in terms of news overall that hit yesterday, in terms of market movement that hit overnight. So stay tuned at the end of this. I'm going to be talking about. I'm going to be talking about a trade plan for the S&P 500 futures, as well as some other interesting things. So, first and foremost, right, Kevin McCarthy ousted, right, as the U.S. House Speaker, a result of escalating infighting within the Republican majority, has renewed concerns that the federal government shutdown could happen next month. Remember, they pushed it along for that 45-day period. November 17th is the new quote unquote deadline, as we call it. So this marks the first time in history that the House has removed its leader and underscores the growing governance challenges that threaten the sovereign rating of the U.S. There's one more rating agency that hasn't dropped the credit rating of the United States yet. So some of the backdrop here: the House of Representatives on Tuesday voted to oust McCarthy as Speaker just 3 days after the bipartisan stopgap spending bill was passed to avert a government shutdown. A small number of Republicans who had sought deeper cuts to the federal budget succeeded in removing him from the leadership role. Representative Patrick McHenry has taken over. McCarthy McHenry has taken over as acting Speaker, and the House will hold Speaker elections on October 11th, and the House will not conduct votes on pending FY 2024 spending bills till a new Speaker is chosen, although House committees can continue to conduct business. So there's still some kind of a shutdown risk, naturally, right? They just pushed along about 45 days. Goldman Sachs said the ouster heightens the risk of a government shutdown next month, adding that McCarthy's successor will face even more pressure to avoid a temporary spending package or additional funding for Ukraine. The near term concerns is that House's paralysis will further complicate the already complicated calculus surrounding the forthcoming funding fight. This is what BTIG's Isaac Boltansky said, that forecasting a government shutdown in Q4 over the longer term, ousting the speaker in this manner is wholly consistent with broader structural concerns regarding political dysfunction in the country's debt trajectory. Right, debt trajectory. We've still seen that the bond market, right, the bond market is getting absolutely destroyed here. TLT, longer term, medium term bonds are both getting wrecked on the vast increase of rates that continuously climb here, right? If I take a look at the U.S. 10-year, last I saw was like 4.8, right? Where are we here? Oh, there's a 5-minute chart. I was like, what's going on? We peaked at did I say 5.8? I meant 4.8. We peaked at 4.885 almost on the US 10-year. Very strong pull down on it. 4.745 trading right now currently. And all this upside pressure in the rate environment in the 10-year yields is putting a lot of downside pressure in the bond market. TLT has had the most ever volume traded in the asset, which is putting a lot of downside pressure. It's a very traded asset here over the last like 2 weeks. Most volume ever traded on the asset was yesterday, as we come down into the 85, 83, 80 region, where we pretty much had the lows of the assets lifetime since its inception, right? These are areas that some people are looking at for maybe a swing to the upside on bonds at lower risks, right? You can just cut it when you start running under some key levels. So it's a very interesting aspect here, but a lot of people are still just crying manic panic, right? Turbo fear that what we're seeing right now in this credit market, in this interest rate environment, in this yield environment, treasuries, this and that, is going to cause a cataclysmic drop that's going to happen within the next month or so, right? These are lagging events, first of all. And second of all, it's very interesting that everyone all of a sudden is a treasuries expert. So bond market is very complicated, right? It's a complex instrument, and it also is the largest market, right? So obviously, if bonds are putting downside press and they continue crashing, it's not the best situation for equities. But right, I think there needs to be a little more understanding and information based on the stuff that we have. Naturally, right, to say that yields rising this quickly and this aggressively is not ideally the best thing there is, but We'll see how that does shape up. I don't think it really affects longer term profit and growth in companies. Valuations for mega cap tech are the lowest they've been in over 5 years right now, making them very attractive for future potential growth. That doesn't necessarily mean that over the next like 20, 30 years, the S&P is going to return 20, 15, 12%, right? The expected value still hovers around 8 to 9%. So keep that in mind. But a lot of this yield talk, a lot of this bond talk, I think that people are going to be annoyingly surprised, right? The masses that generally come together and start talking about a cataclysmic event suggests that the bottom is probably in and things are about to roll over, right? Things that are cataclysmic are things that are unseen and unknown, right? There's something in front of everyone's eyes. I think that people are going to be weirdly shocked to see what comes in the next few weeks here, right? Especially into the end of the year. So keep that in mind. But Wells Fargo, right, expects the separation between mega caps and the rest of the stock market to begin narrowing soon. So mega caps, about 7 to 10 stocks, are the only things that are pretty much holding this market from that capitulative downside spiral note, right? Suggesting that triple Q's Nasdaq is holding extremely well, while S&P is slipping. IWM Russell is slipping pretty aggressively, and this is due to the fact that about those 7 to 10 massive mega cap, especially tech names, are just sustaining their value, holding out very strong, and that rug pull is the final move lower that we need to see for the capitulation of the market, and that's what I think a lot of people are waiting for. So we'll see if that actually comes out, right? There's a lot of macro pressure raising the odds of a possible catching down for all of these names, right, in the tech sector specifically, and we expect a recent outperformance of large cap names to eventually correct either by top names catching down or the average stock catching up to those names, right? This is what Wells Fargo said. Well, obviously it's going to be one or the other. Realistically, I would lean a little more on the rug pull in tech, not too aggressively to the downside to see that capitulative move before we start seeing the buy side come in. Right? Remember, smart money, big money starts buying when there's that mass capitulation. There are some signs, but the indication that we have seen that capitulation isn't there necessarily just yet. So the average stock will likely will continue struggling as Wells Fargo sees a recession on the horizon. 7 mega cap tech names drove the majority of the market returns over the last month, and investing group leader Lance Roberts explains that traders are chasing mega caps with a reckless abandon. So, right, seeing that there's value in them, they're holding out. Retail is funneling into these a little late. A lot of this, like we've talked about earlier, we talk about this a lot with our group, that the recession on the horizon has decent probabilities of coming in. But the thing is, I think that the expected move is going to be a little later than everyone thinks. Everyone thinking Q4 is the time, but I think it prolongs a little further than that. But there is a very big discrepancy between a lot of these names, but valuations are still relatively low, right? Something to consider, something to keep in mind. Now, if we look at the S&P 500 futures here, right, seeing what we got a pretty hefty 40, 45-point rally off the lows of the overnight session, as yesterday we accumulated a lot of volume into those lows. There's a very, very important level everyone should mark on their chart, 42.81 to 82. It's marking temporary highs here on the overnight session, and there's massive order flow that just went reoffer, and that was the peak inflection point that led for the next 50 points to the downside. So anything back above that, right, buyers are going to be pretty happy about that. You got the 72, 74 area as the first support. It's very, very close to where we're at right now. So if we can see some profit taking to start the day before we see a little more of that buy side, that would be a pretty good move for the longs to continue the momentum. I would much want to see 65 hold out as that support, final support around 58. I don't really want to see price drop 20 handles to get into that next support. I'd rather see buyers step in a little more quickly if there's going to be any buy side on the day to see some kind of a relief rally before bears try this yet again, right? Upside, we have that 93.96 and then 43.03.05. So hope everyone had a solid update. Has a good morning here. Marco, welcome. Good morning, brother. And what we're going to be doing today is jumping in our live trading room in just a bit. But check out community.tradepro academy for our free Discord, where we also have a free futures course on our site. But also, right, this coming October 10th, Tuesday, we're going to be doing a seminar on understanding directionality in the market using order flow profiles and understanding order flow pivots at inflection points based on volume, where the strong-handed traders are, where the big money is, so on and so forth. So hope to see you all there. let's get ready, right? So enjoy the day. Happy Wednesday, middle of the week. We'll see what we get today. Take care, everyone.